The Tax Cuts and Jobs Act represents changes to many provisions of the tax code, including revisions which could have an impact on the use of trusts as an estate planning transfer device. Joining us now for today's Rural Money segment is Roger McEowen with the Washburn University School of Law. Roger, as always, thanks for joining us this morning. So what is the impact of the tax cuts legislation on trusts and also estates?
Well, good morning, Janet. Good to be with you. I think probably the biggest thing people need to remember is that the compressed tax bracket structure still remains under the Tax Cuts and Jobs Act for trusts and estates. In other words, you're going to hit the very top 37% tax bracket once the trust or the estate has income over $12,500. So it doesn't take very much to get to the top, and that doesn't change under TCJA.
And what are some of the other aspects of the trust and estate taxation?
Well, the limit on the aggregate deduction for state and local real property taxes and income taxes is $10,000. That's a maximum on an annual basis, but it does not apply to any real estate taxes or personal property taxes that a trust or an estate incurs in the conduct of a trade or business. So an active farm business that's conducted by a trust or an estate will not be subject to that $10,000 annual limitation. I think that's key.
The Act also suspends miscellaneous itemized deductions for a trust or also for an estate. What exactly does that mean?
Well, I think that means two major things. One is that investment fees and expenses, as well as unreimbursed business expenses, are not going to be deductible. But we still need guidance concerning the deductibility of administrative expenses, such as trustee fees. It's not really clear whether the Act impacts that particular section of the code. And so that's going to be a key issue going forward. We really need guidance from the IRS on that one.
So, Roger, before we wrap things up, can you also speak on the new 20% deduction for pass-through entities?
Yeah, that's an important one because it does apply for an estate or a trust that has non-C corporation business income. So the trust or an estate can claim that 20% pass-through deduction. And it's claimed at the trust or the estate level. And so you've got a $157,500 threshold that applies to a taxpayer filing as a single person. That's what applies to a trust or an estate. And so that's a key pass-through deduction that will count for a trust or an estate.
Okay, Roger, as always, thank you very much for your insight. We certainly appreciate it. Talking with Roger McEowen. He's with the Washburn University School of Law, joining us on the phone this morning from Topeka, Kansas.